Good morning, everybody. Welcome to the debt limit ceiling. Today's date, first of all, it's a Monday. It's a pre-market at 5:34 a.m. Pacific Standard Time, and we're starting the month of August, called the dog days of August, and the earnings cycle has passed us by to a great degree. Not all of them. We'll still have a lot more of those earnings coming in this week, but we're at the tail end, let's say. And what we have is a pre-market gap list that is extremely long based on the pre-market futures, based on artificial price movements, not like everyone in the world sitting here buying these. But this is called upside price action volatility, just as 1 week ago Monday, when there wasn't a resolution, it was quite the opposite. And we have that pre-market futures last Monday as reference to this one, bottom line. So therefore, by understanding price action volatility, and as we have said very clearly back in March of 2011, that as we were going to clear out of that little seasonality spring rally deal, is that we would see a different picture. And that picture was going to be the clear-cut picture of volatility that even the day trading community can't keep up with. It's way beyond what they ever learned back in the late 90s, over a decade ago. This kind of volatility, though, however, makes a market maker a tremendous amount of money, because you're getting the mathematical volatility to the upside, and you also get the mathematical volatility to the downside. Okay? Right there, just a second ago, that price line was $17 and then dropped $5 just in one print. And it's on this video under the gap open list. And you can already see that the upside volatility and downside volatility, if one understands the trade management correctly, can do extremely well in these environments. It's the best environment to be in. But it's only for a selected, very small percentage of the population. This kind of volatility is very high risk to people who do not understand it because of the emotional part that it takes. Right now is a great day for people like us because, once again, having upside call contracts versus a downside one for either which event would be okay. Whether this was red or green, it wouldn't matter to us. And therefore, that keeps us totally neutral, as it should. The trade management for the day is that on the opening bell, what you will have is when we went into the closing bell Friday, we sold off last week, and basically this upside volatility gap is what we lost when they weren't making a decision. Now that they made the decision, you're getting the mathematical volatility back up in today's gap, open bull gap. So the bull gap, as we go through the opening bell, the bear is below the market. So all the short sellers are below all these prints. All right? And a short seller is going to have to buy to cover. Okay? And once the short seller buys to cover, and on the intraday high, you'll look to the left side of the market. That's where it slides half of that SMF bar at the high, intraday high. Price action is finally there. But what happens up there is there's no buyers at those price levels. Therefore, the upper price channels, the upper deltas, the opening delta gaps in our system can travel up, but at some point up there at those price action lines are going to fail because there's not going to be any buyers, and that is when the time to short will be put on for an intraday only. So the other piece to it is how distribution comes in at those highs and starts selling into the pre-market debt ceiling gap, meaning that for the last several weeks there has been a distribution model in play, and the only time that big institutional people can unload some shares are on days like today. I have to have someone to sell to. They don't want to disrupt the market, but they've been doing it for a number of months. Amazon had a headline this morning. Wynn has got a gap up because it had some headlines out of Macau in its earnings. We know that. There's the beaten down Netflix. They're all getting big gaps. But these are formula gaps that we're going to be developing for our MMTs moving forward, so that on the days up, this is called a right elbow super gap in the SMF platform, up above in the delta prices. You can start at a delta and higher in a lot of these, delta and a half, delta 3/4, delta and a quarter, whatever the case is going to equal a certain price, MMTs. And it's also going to equal where we can run up to the next price level, but at the upper end, when we do hit that final delta price level, the ratio high of the day gets put in. There won't be any buyer there, and you'll start to see the gradual and incremental contraction start to take place in price action, which will mean that price action it weakens at those levels. And once it weakens, then the down move follows. It doesn't just happen right away, but it will. So we have a tremendous gap open on a Monday morning on the NASDAQ. Basically, the gains that were given up last week, as we said, within downside volatility, uncertainty, upside volatility, as the uncertainty is removed, well, it doesn't matter. You get the counter volatility. Volatility is wonderful because you get downside and you get upside. Why do you think we cover pre-market futures every morning and do our trade management? It's very important for us to know where we're at. We know where these stocks were. We know how they sold from their last highs all the way down to this volatility gap. We already know that. We were there every single day of the week. So basically, that's the trade management on how things are going to happen. There is some key economic data coming out. You're going to have at the 10 o'clock hour the ISM index, and I think construction spending as well. Okay? So after today, the world will go back to worrying about emerging market turmoils. The ISM index and construction spending will be out on top of the hour. That will be at 10 o'clock Eastern, 7 o'clock Pacific Standard Time. ISM index is going to be a very important thing because anything below 50 is contraction and anything above 50 is, just right above 50 is just holding. But you want that number to be higher towards 60 or 70 because then you know that things are good for the U.S. consumer. U.S. consumer payroll. We're heavily economically data this week. And we got the Jobs Challenger report, the ADP, the monthly unemployment report coming out. There will be also the ISM services later in the week that comes out. This is the opening futures volatility at 5:43 a.m. Pacific Standard Time on the U.S. debt ceiling. And 1 week ago at this very time on stockmarketpunding.com, you could go back and look at the pre-market video. It was just quite the opposite. So MMTs, you need to flag this with last week so that you have the two of them clearly put together and that you have a clear foundation of seeing the volatility and how volatility works. That's the trade management on the NASDAQ comp. Welcome to the month of the dog days of August on August 1 of 2011. Moving in to a whole different trade management in September and October called asset allocation models.